All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm going to be brief here this afternoon. Not a whole lot to really add to what's out there. We saw earlier today the tweet from U.S. President Trump, and I talked about that on video. Talked about just the change in rhetoric in that, the escalation in that just is yeah, we've seen escalation of the trade war. This is probably the worst escalation that we have seen. Basically, referring to China and the Chinese premier as an enemy, which is, I totally understand. U.S. president sometimes doesn't measure every word that he says, and that's part of his nature. But whatever side of the aisle you land on politically, right? You have to look at that tweet and go, there's not a reactionary approach to that tweet. That tweet doesn't seem like he just fired it off. That tweet seems very planned, seems very coordinated in how it came across, and so I'm sure the word enemy was used with at least some thought. So some significant escalation there. We've seen the market fall off and fall off sharply. It's down near the lows of the day. Right, this is something where if you look and you say, okay, what catalyst is there to buy right now? What reason does someone have to buy right now? If you're a fund manager, heck, if you're a trader, what reason do you have to buy right now? About the only real good reason that you have is either if you're looking at something super long term, significantly much longer term, or if you think that U.S. President Trump is going to have some some different words come out this weekend. President Trump in his tweet did say that there was more to come. So we're not going to get out of the weekend, at least. We may not even get out of the trading day today without something. I would not be surprised to see a 20-point shot up here into the close. I also would not be surprised to see a 40-point downdraft here into the close of the market today, based on that next tweet that he has promised that he will deliver here. We are seeing the U.S. dollar fall off. We're seeing oil fall off. We're seeing gold rally. We're seeing the VIX rally in a big way. Now the challenge is in all cash. I did jump on shortly after the morning video, shortly after the Trump tweet, and sold out of Visa, sold out of Micron. They were both positions where I knew I would have to get out this afternoon, regardless of what happened. And it just, with that news, we've seen it before. It just, we saw a spike in the implied volatility, so took both of them off and ran here and put the challenge back into all cash. Both have continued to bleed on lower here today, and in ways that are fairly bearish there. Now, there are no bearish signals here this afternoon, and I thought there would be a good chance, but there aren't. And one of you has been at me a little bit over the last month. Hey, where are the bearish signals? Where are the bearish signals? Because when we look right at the triggers that are out there, we haven't seen a lot of bearish signals. It's been mostly bullish signals here within the signals that have come in this challenge. We've had a few bearish signals, Raytheon and Amazon and I believe was it Triple D there. So we've had a FedEx bearish signal. We weren't able to trade because we were in other things, but we haven't had nearly as many bearish signals as bullish signals. Now, much of that's a product of the fact that market just recently set new highs, right? And the way the algorithm is built, it's not going to give a bearish signal off of a brand new high. But there is another factor at work here, and this morning when I talked about the next challenge, we'll probably tweak the algorithm a little bit, right? The algorithm was tweaked going into this challenge to make it a lot more difficult to get bearish signals. Now, why would we do that? What's the motive behind that? Um, well, it's not that the signals aren't similar. It's just we've tightened the consolidation factor on downside signals, meaning it's got to be a very strong signal for us to get a bearish alert that can be traded for the challenge. And did that for a number of reasons. One, because we're going into the summertime chop, right, which we know what the market environment can be. And when we go back and look through the data, some of the biggest losses for the challenge actually have, or in the trades, has actually come on bearish signals that get whipsawed to the upside very, very quickly. And so we decided to tighten it up. It makes sense because option values tend to be a lot higher, right? And so when you're wrong on a put and you get a big nasty whipsaw, you're going to lose implied volatility, you're going to lose delta, you're going to lose a heck of a lot more. So, we went into this challenge wanting to lower the risk component just a little bit, and that's how we did it. We will be expanding it most likely going into next challenge. In why? Well, simply because the overall nature of the market is shifting a little bit, right? And there is more downside risk coming into the market. I do still believe market goes to new highs, right? I still stand by that. But we may be looking at a market that's remarkably different here in a few weeks, depending on how how things go here. In terms of the trade war, in terms of the Fed, they are definitely going to to move things. But for now, remains in some chop. Outside of the metrics, outside of the challenge and everything else, this is a really interesting move. And it's the type of move that we will often see as Bollingers start to contract. We get a failed breakout, right? And let's face it, if the catalyst this morning was positive, we would see the market all the way up here at 3,000 again, right? We would see it up at this upper band. The catalyst is negative. Chances very high of the lower band being revisited here with the S&P. If you look back in October, November of last year, we saw that type of nature, and I do think that barring some sort of major news catalyst, to come out, U.S. President Trump tweet, whatever, that path of least resistance is at least going to be the lower band, and that risk of the 200-day moving average is still on board here. But we talked about the element of a triple bottom earlier this week when it came to S&P futures, and this idea that was written about that, hey, you know what, the market has a triple bottom in play, and now it's going to break out to the upside, and kind of where the flaws in that logic were. And one thing that just hasn't happened, whether you buy the triple bottom or not, we haven't had the breakout. Right, we haven't seen the breakout of that. So, we could be going back down to, revisit again and now get a quadruple bottom, right? Which has the same elements of a triple bottom. It just is a quad, right? And so it's just, one of those things I bring up just so that you're aware, of how that, is transpiring there. It would be very bullish if the market were to just turn around here and then break 2940. That would be extremely bullish coming off a higher low. But a lot would have to happen to make that happen as we go forward into next week. All right. Thanks for hopping on. Have yourselves a fantastic weekend, and we'll talk to you on Monday. Take care.